Good evening, everyone. Welcome to Marsh's webinar on new risk order, business interruption risk and insurance claim. It's 3:57 and we have few more minutes before we start. And we have more than 50 people already joined in, around 40 people. So we'll wait for some more time before we begin. Thank you. Good evening, all. Welcome to the Marsh's webinar on business interruption risk and insurance claim. This is part of the series of webinar which Marsh is running with the theme of excelling in the area of risk and insurance. With these webinars, our intent is to bring our best of our experts from our regional offices, global offices to share the best practices and insurance related ideas, emerging risk related issues. Yesterday, we had a fantastic webinar on emerging risk and resilience. And today we bring to you a very important subject, which is business interruption risk and insurance claim. And as we are going through this a public health crisis of pandemic, this is an extremely important topic and a very topical area which we thought it's important for our clients to focus on. And with that intent, we have a very distinguished panel over here. As we speak, we have around excuse me 75 plus participants, and we will just wait for one more minute before we begin. While we wait for some more participant to join in, a quick introduction to Zoom who have not used it before. On the panel you will find Q&A tab. Feel free to put questions as our speakers lay down their perspective on the area of business interruption and pandemic risk related issues. Keep putting your question in the Q&A tab. In case you want to speak up your question, please feel free to raise your hand. We will try to unmute your lines and we can have you speak live. During the webinar we have polls, live polls, few of the live polls, so would encourage all of you to participate in the polls. Next slide. A quick introduction to the panel, to the esteemed panel today. So we have Glenn Eaglestone. He's the Asia practice leader for FACS, which is Forensic Accountant Claim Services. He is currently based in Australia. We have Dennis Dalati, who is head of claim practice for Asia. We have Seth, who is the chief client officer for North Asia. And we have Pranav, senior vice president at Marsh India. He's part of the energy team. So with this, I'll just take you briefly towards the the first poll question, just to check how all of you are. How are you feeling today? Calm, anxious, very stressed. So this pandemic has been with us for now more than 6 months, and it's important to know how are you feeling today. Yeah. So yeah, 81% is feeling calm, and there are few which are feeling anxious and very stressed, which is understandable. So with this, I will just briefly touch upon what is the agenda for the webinar and what we are going to cover in this webinar. Glenn will talk about the business interruption in the COVID world. What are the important tips and areas which he thinks our clients should focus on. Dennis, who is our claims practice leader in Asia, will talk about COVID coverage related challenges we are seeing in the region and what is the outcome of FCA test cases. Pranav will talk about some of the impact of new clauses on the area of business interruption in India. Seth will talk about epidemic risk solution and parametric solutions. He'll briefly touch upon the parametric solution also. We have an upcoming webinar on parametric risk solution. So those who are interested in having more deep dive in this subject, we have expert from our Asia team to talk about that. So with this and no further delay, I will hand it over to Glenn and he'll take you through the business interruption piece. Thank you.
Thanks, Ashish. So I'll discuss business interruption today. So I'll start with just a little bit of background as to what business interruption insurance is, and particularly why it's important. We'll then discuss some of the usual core considerations for business interruption coverage, then move on to what's different in the current and COVID and the future COVID world, and give you some tips on renewing your business interruption program. Next slide, please. So firstly, just from a bit of background, business interruption, also known as BI, is also known as consequential loss and time element in different regions. Different insurers, different regions like to use the different terminology, but it really means all the same, really. Business interruption is part of your property program. And what you will typically find is within the property program, you will have two sections. If you could hit next slide, please. Within the, go back one. Sorry, part of it's missing on that slide. Section 1 for the property program would normally cover property damage insurance. So what that is typically doing is covering the assets of your business. It's akin to thinking about covering your balance sheet. The second section would be for business interruption insurance. The idea of that is that it covers the income of the business. Again, you can think of that as protecting your profit and loss account. Ultimately, the property program and the property policy is a policy of indemnity. It's intended to restore the insured to the financial position that they would have been in had the insured damage not occurred. Okay, next slide, please. There are many surveys and reports issued each year in the insurance and risks sectors, many will rank the most important risks affecting the business each year. The Allianz Risk Barometer is one such survey. Having been the most important risk for the last 5 years, business interruption was knocked off top spot in 2020 by cyber. Business interruption is just as important as in previous years, though. It's just that cyber is becoming front of mind now. So many businesses, for many businesses, it's caught up BI and it's actually slightly overtaken it. Although with the COVID world that we've just had, who knows what will be there next year. I wouldn't be surprised if business interruption is back to #1 spot. Ultimately, though, this doesn't diminish how important business interruption is to your business. The average insured BI loss from a fire is now around $6.7 million US, which is 45% higher than the corresponding property damage. Losses at customer and supplier premises, known as contingent business interruption, or CBI, are larger and more widespread than in previous years. In many industries, there are highly efficient global supply chains, but this increases the company's vulnerability to CBI events. All this means that it's more important than ever to have appropriate business interruption cover. The purpose of business interruption insurance is to provide the cash flows to support the business in the event of a loss, essentially to fund the business continuity plan. If business interruption insurance is not right, in the event of a significant loss, the continued survival of the business is put at risk. Next slide, please. So with that, I'd now like to discuss the usual core considerations of BI cover. We'll start with average. So the average clause is used by insurers to limit claim payments for those policyholders who have not appropriately insured the BI risk. As an example, if your insured value is $80, but following a loss it was determined that your declared value should have been $100, then you'd only get 80% of your claim paid. This means it's important to get the declared value right to avoid the average penalty. Next slide, please. When considering your sum insured or your declared value, there are various elements you need to get right. Firstly, what type of cover is best for your business? This could be gross revenue for those businesses with very few variable costs. It could be standing charges for those businesses that do not want to insure net profit and only want to insure ongoing fixed cost cover. Or maybe additional increased cost of working only for those with limited exposure to revenue losses. Or the cover that suits the majority of businesses is likely to be gross profit. Gross profit cover, when applied correctly, is designed to put the policyholder in the same financial position as if the insured loss did not occur. Secondly, what are your maximum revenue expectations? You need to consider growth until the end of the maximum indemnity period. With a 12-month indemnity period, and assuming a loss occurs on the last day of the policy period, you need to forecast revenue for at least the next 2 years. And finally, you need to consider the appropriate split between fixed and variable costs. This will help to ensure that you don't suffer uninsured losses in the event of a claim. The third element to consider is the maximum indemnity period. This is the period of cover provided under the business interruption policy, and it's the length of this period that's the decision for the policyholder. Even though 12 months is standard for many industries, this is often not sufficient. Many businesses require 24 or even 36 months cover to ensure they have a sufficient period to recover the business. We'd now like to think about what is different in the COVID-19 world from a business interruption perspective. Next slide, please. Here we have a chart with the objective of identifying some of the challenges faced with estimating the effects of COVID-19 on the business interruption value of the business. On the left, we have the start of COVID-19. In reality, the effects of COVID-19 could differ widely to this simulation, depending on the industry you're in. The sudden onset of the COVID-19 pandemic has affected businesses in a variety of ways. There are rapid increases in activity for some, including supermarkets and logistics companies. Some are seeing minor or no changes, for example, banking. However, some are seeing significant negative impacts, with many businesses closing units or locations. This is especially true for hospitality and travel, although there are many other industries badly affected. The first challenge is considering your business interruption insurance values is to try and estimate when the recovery will start. This will be different depending on the industry, the location of the business, and the location of the business's customers. The next challenge is to estimate the rate of recovery. Will it be a slow, steady recovery, shown here with the red line? Or will there be a little bit more growth, shown with the blue line? Or will the business be fortunate enough to be in an industry and location that will recover relatively quickly, with growth returning to pre-COVID days? Other questions that need to be asked include whether you've mothballed or permanently closed some of your locations. Have your payroll costs changed significantly, either up or down? And do you have an increased reliance upon a few customers or suppliers? And how are they coping in the COVID-19 world? In order to estimate the BI declared values, you need to consider the likely effect of all these challenges on your business. Next slide, please. So what happens if you get it wrong? We have the same simulated data here, but let's assume that the business suffers an insured loss near the bottom of the COVID effects. And let's assume that there's a reasonably long indemnity period. You can see now why it's important to predict how quickly the business will recover. If you assume a low recovery when preparing your BI declared values, which would be the red line, it's likely your claim assumptions will significantly exceed your declared value. So if you assume a low recovery when preparing your BI declared values, the red line, but then other post-loss data suggests it would have been a high recovery, which is the green line, it's likely your claim assumptions will significantly exceed your declared value, so you'll be underinsured. Having been through arguably the most challenging period for any business during COVID, the last thing your business needs is to suffer an insured loss and find you have inadequate cover, with all the potential upside from the recovery being removed from the claim due to the application of the average clause. So what does that mean for your business interruption program? Next slide, please. So here are a few tips when you go through your next business interruption renewal. So firstly, make sure your maximum indemnity period is sufficient. Failure to do so could result in large uninsured losses. Secondly, when considering growth, try to predict the future recovery of your business. You should consider a possible loss at the end of the period of insurance. Estimate what growth you might achieve both during the period of insurance and throughout the maximum indemnity period. This will be different for each industry. What rate of gross profit would you expect? Would this be the same as the pre-COVID-19 period? Or will your normal costs of business have changed, either up or down? Many businesses are operating what is becoming known now as the new normal. But what's that new normal for your business? And finally, get expert assistance when required if you're not sure what to do. Next slide, please. So we now have a poll question. How confident are you of correctly capturing BI insured values of your business and the optimal indemnity period? Confident. It's a good result. Although I think with all the challenges of COVID, there will be a lot of challenges coming forward. So with that, I will pass the floor over to Dennis.
Thank you, Glenn. Hello, everyone. I'm going to talk about the market reaction to COVID-19 and the associated coverage challenges. COVID-19 caught everyone off guard, and the insurance market was no exception. whilst pandemics have occurred in the past and expectations that they will occur again, SARS was one example, no one really predicted the scale that we've seen with all of these global 19 impacts. In terms of COVID-19 insurance claims, it is fair to say that the majority of COVID-19 claims were repudiated by the market and are currently undergoing legal challenges. Standard insurance policies, to be fair to the market, probably were not designed with global pandemics in mind. Although infectious diseases impacting businesses are scenarios that were considered by markets when designing policies, they tended to have more of a localized impact in the mind of underwriters rather than the global pandemic that we experienced. So I'm going to focus this presentation on standard property policies and the coverage challenges associated with COVID-19, rather than some of the other bespoke policies such as event cancellation, third-party liability, and some trade credit products out there, as those have proven to be less controversial so far. For property policies, the standard clauses that have been relied upon are non-damage extensions. As some of you know, property policies by and large require damage, that is physical damage, as a trigger in order to be able to claim business interruption losses. But there are some exceptions. And so in your standard property policies, there are some non-damage clauses that do allow us to claim business interruption losses without requiring some sort of physical damage as a trigger. So it is these clauses we'll now be focusing on and are, currently the subject of much conjecture in the market and in the legal courts. By the way, as probably has been seen in some media outlets, labeling the virus as causing physical damage in an attempt to claim that virus on your premises is actually triggering damage to your physical property is an avenue that is being explored currently, but with no real success to date. And unlikely to be successful having that particular argument. But you never know, But I've steered clear from this particular approach in this presentation due to the likelihood of that particular argument getting over the line. More likely coverage avenues will be via typical non-damage clauses we have in Asia, such as prevention of access due to government order and or closure orders due to an infectious disease, either at the premises or within a radius of the premises, as stated in above slide. If we can go to the next slide, please. Thank you. So, as mentioned, the main potential triggers of business interruption losses during the COVID-19 period are due to government order closures, either due to disease being present at the premises or within a radius of the premises. So typically, what we've seen so far for those insureds that did have these type of clauses, this type of prevention of access, non-damage or infectious disease clauses, if these insureds were able to demonstrate that, hey, we did have a disease, in fact, present at the premises through a sick worker or a sick employee, etc., or a guest at the premises or within the stipulated boundary that's basically stated in the policy, and then the premises were shut down due to the wider government shutdown orders. All of these type of insureds did lodge claims to try to recover full business interruption losses. And we don't necessarily blame them for doing so, because at face value it looks like those policies should trigger. However, the market and insurers argued that in order to claim these losses through these particular clauses, non-damage clauses, the insured would have to demonstrate that the losses at the premises or within the stipulated boundaries were the main driver of the losses experienced by the business. So if you, for example, had a guest that was infected at your hotel, then you would prima facie trigger the policy, but the insurers would say, well, you need to demonstrate that that particular sick person caused your business to shut down and not the wider government orders due to the nationwide lockdown of the disease, okay? So that was insurers' positions. They were basically arguing the proximate cause of the shutdown had to be the disease at your premises or within the stipulated boundary and not the wider area government shutdowns. On top of that, they argued that even if you were successful in triggering the policy, due to the wider area damage but for test, which is called the trends clause, your claim, whilst triggered, could then be adjusted to zero. So ineffectively, it's what insurers are arguing is that had the event not occur at your premises, you would have been affected by a reduction in revenue in any case because of the global economic downturn and the global wider economic shutdowns. So if you had no instance of COVID in your premises or within radius, you still would have suffered the exact same losses. Therefore, even if you were to able to trigger the policy, we would expect to adjust the claim down to zero in any case, as that's the new trend of the business. The new trend of the business is zero, okay? It was this interpretation really that effectively denied 99+% of claims out there. This caused some concerns by regulators around the world. In the UK, we're one of the first ones to effectively scrutinize this particular position by insurers. So as such, the Financial Conduct Authority, FCA, you'll see that the acronym FCA mentioned a lot, is the Financial Conduct Authority of the UK, put forth a test case to resolve some of these key contractual issues with the High Court and causation issues and provide some clarity around for policyholders. They did this by reviewing a sample of policy wordings. So it's not a catch-all for all policies, and I'll explain a bit later on how some of these sample wordings differ from some of the wordings we have here in Asia. So in a nutshell, if we were to summarize, insurers' reaction and position to COVID-19 is that they contended all along that these non-damage wordings are really intended for very localized outbreaks and not a wider area pandemic. So how did this view fare in the High Court decision that sort of came out recently from the FCA test case? Next slide, please. Okay. Thank you. So the FCA test case, some of the key considerations. So back in May in 2020, the Financial Conduct Authority announced it would bring a test case to the High Court. It's important to understand that this particular test case is a UK test case and it's not necessarily binding in other jurisdictions, but most of our countries that we sort of deal with are dealing with common law type of interpretations. So it does have relevancy and potentially could be used as a way to effectively set a standard or legal precedent in countries that do have common law principles like India. So the test case was brought in May 2020. In September 2020, the court found in favor of the arguments advanced by the policyholders on the majority of the key issues. So that was basically the news, is the policyholders, insureds won effectively. But there's a lot more to it than just that headline. The key considerations where they looked at was prevention of access, non-damage, infectious diseases, non-damage, and the trends clause. As mentioned before, the FCA case did not consider physical damage considerations, only non-damage wording. So they didn't even bother looking at this whole concept of the virus causing damage. Okay, that was something that they did not even consider. Next slide, please. So, insurer's position. Losses due to COVID-19 must be directly linked to the losses presented at the premises or locality, not the wider area closures. The court decision. Generally speaking, when they reviewed some of these clauses in the policies, they disagreed and found that the proximate cause of the disease was the disease as a whole across the country that also had a presence at the locality or premises. So some of the clauses were broad enough to effectively say or state that the disease was the main driver of the losses. And as long as you had disease present at your premises or within the locality, irrespective of the wider closures, you had cover. But there are many other nuances to this particular decision because there are many other clauses that specifically state, and some of these semantics can come into play, that a direct consequence of the localized occurrence or event has to have occurred. So there may be words within the clause that say as a direct consequence or as a direct event in that clause. If those clauses have that particular wording around it, as a direct consequence of, as a direct event of, the court found a far narrower interpretation. And it's likely, and these clauses have these type of wording attached to it, that insurers' position that the losses located at their premises had to be the main drivers may well be a winning argument rather than the other clauses where there's no such link between the disease at the premises and direct consequence of. So while certainly for those insured that have those specific clauses that the FCA looked at and reviewed and ruled on favorably, the test case would be of great assistance. So here that clause where the court said, yes, this particular clause, we found that you can claim wider losses irrespective of the proximal cause argument, then a great assistance. However, in Asia, now none of our wordings or clauses really match exactly what the FCA looked at or ruled upon. So a lot of interpretation will be required to really distill it down to the specific wording we have here in Asia. And a lot of our Asian wording does have those unfortunate words direct consequence of. So you may require some sort of legal technical argument before we are able to really ascertain whether the clauses here in Asia are covered by this FCA test case. So there may be some limited values for us here in Asia. Therefore, we may not see as much success in Asia or India with some of these wordings that have indirect consequence of, as opposed to some of the FCA UK wordings. So, and generally speaking, also the court also ruled that government orders had to be mandatory and enforced by law rather than just a recommendation. So there had to be some sort of mandatory order as well. Next slide, please. One of the other big deals that was basically ruled upon, and this is really important one for us, is the trends clause, as I mentioned before. The trends clause insurer's position basically was, even if you managed to trigger the policy, let's just say we trigger the policy, that they could adjust the claim down dramatically to close to zero. The insurer's position was that trend clauses would effectively negate most claims in any case, as per the Orient Express case law, which is the previous precedent that was set in a previous court case. But for the damage or closure of the business would have suffered the same losses in any case due to the wider national lockdown. So the trend of the business is zero because the economic downturn is such that you have derived zero revenue anyway. Now, the court, again, generally disagreed with this particular principle, and they recommended not following the Orient Express previous legal precedent that was set. As such, this particular area, the High Court ruling potentially allows for the calculation of losses to be based on business performance that would have occurred had there been no pandemic and no government shutdowns, rather than measuring business conditions with the pandemic and national lockdown in place. This is actually a big deal because it has implications beyond COVID for the future. This will cover losses that have wider area implications, things like essentially wider area events like typhoons or natural disasters and pandemics. So it has no relevance to triggering a policy, but it has a large relevance to calculation of losses. And a lot of the slides that Glenn earlier spoke on was about essentially understanding trends of business and forecasts, etc. This will be a big help in terms of being a more generous calculation of losses should you suffer a wider area damage event like COVID-19. So it's definitely being more generous if this particular finding is overturned. Now, we're all looking with keen interest because this is currently being appealed. So we're looking to get to a final conclusion on where the High Court and Appeals Court in UK come down on this particular area of policy coverage and calculations. Next slide, please. So what has been the market reaction to all of these COVID-19 claims that have been hitting the insurers? Well, predictably, reactionary in a lot of cases. The market still maintains that they never really intended to cover pandemics of this scale and nature. Hence, we're going through some of this appeal processes right now. They've already started putting exclusionary language to start into new policies to ensure that they actually exclude COVID-related or infectious diseases going forward. Similar to what happened in 9/11 with terrorism exclusions in property policies, there's will be likely a push to have standalone policies for pandemic cover in the future, rather than just apply infectious diseases on your standard policies. Okay, the same happened when 9/11 occurred. Terrorism tended to be part and parcel of property policies. Since then, it's been pushed to have sort of standalone policies, and the same thing may happen here as well. There's potential avenues for industry and government-funded insurance vehicles to cover these type of events. We'll be talking a bit about parametric cover in the following slides. Again, there's another avenue potentially to use as a solution going forward, and it's been discussed about. And the legal case ruling out of the FCA will likely have decades-long repercussions on how policies are interpreted and the quantification of losses. So we're all very keen to see what happens there once the appeal process runs its course. So these are the things we should be looking at going forward. With that, I'll leave it at that and give it back to the poll question 3. How concerned are you about the impact of future epidemics on your business? very concerned, concerned, slightly concerned, or not concerned at all. Looks like everyone's concerned or very concerned. Absolutely. I mean, this has been a tough lesson for all of us, and that's probably the right ratio, I imagine. Thank you.
Yeah, thanks, Dennis. So, now that we're going through the pandemic and, there's so much of uncertainty that this pandemic has caused amongst the insurance community, and in particular insurance companies. They really want to control their exposure. Their exposure has really taken a beating on a variety of fronts, and with an effort to keep a tab on what hits their balance sheets, they've come up with new endorsements primarily in property policy. So I'll just be taking you through three key extensions that have been quite recently introduced, and some of these have far-reaching consequences. So let me start with the communicable diseases endorsement. Now, with effect 1st April 2020, every property policy in India has a communicable diseases endorsement. And this is as a result of GIC's diktat. So all of the GIC-led programs, and even those led by other leading reinsurers of the world, have a similar endorsement. So not necessarily the same communicable diseases endorsement, but something similar. So that reads, very much like this endorsement. And the intent is essentially to exclude any loss, damage, liability, claim, cost or expense directly or indirectly contributed to or caused by a communicable disease. Now, on the face of it, it looks quite innocuous, but it can have some very, very serious ramifications, implications on a claims payout. So our area of concern is that how would you treat losses that could be very indirectly linked, to COVID? And if the intent is not there, it's not too difficult to link any loss to COVID, considering that the current pandemic has affected virtually every industry, the entire, the gambit. So virtually, every area and, whatever you can think of has been impacted in some way or the other. So, for example, if there's less manpower at the site, if there's a delay in carrying out maintenance work, inspection activities, human error, a delay in safety equipment reaching the site. Now, if any of these could, potentially impact the loss, as per these wordings that I just read out, the claim could come under a question mark, and we don't want that to happen. So, we've sought clarity from the insurance community, and clearly we need to be very, very clear about what's covered and what's excluded. And we'd like insurance companies to, say upfront what exactly their cause for concern is and what they're covering and what they're not covering. So that's as far as the communicable diseases endorsement is concerned. The next I'll talk to you about is the BI volatility clause. Now, this is a clause we've seen in large risk policies. We haven't really seen it in the industrial all risks policies or the fire loss of profits policies. So really, that's not, they've not been incorporated in those policies that are for slightly smaller risks. But for the large risk policies, this is quite commonly observed. And I'll just give you some background as to why insurance companies have introduced this clause. Now, once the recovery post-COVID starts, and even otherwise, it's quite likely that insurance companies will see a spike in their BI exposures. And this could be far more than what they anticipated. And if you had a loss during that period, the exposure and the payout would be considerably more. Our area of concern is that this shouldn't impact our clients adversely. We don't want payouts to get affected and an unsatisfactory result because of this clause. So it's important for industries that anticipate a very sharp growth and sharp recovery post-COVID, and industries with seasonal fluctuations. Now, most industries have fluctuations in their revenue numbers across the year. Very few industries have linear figures across the year. So there will be ups and downs. So it's important to capture these ups and downs, these variations upfront, and present them to insurance companies right at the inception of the risk so that they can see it, they can underwrite it accordingly. And at the time of a loss, there are not too many questions asked and the payout is satisfactory. So our advice is to capture these fluctuations upfront and disclose them to insurance companies right at the inception of the policy. The next one is the loss prolongation clause. Now, I'll just give you some idea of what this clause is about. If you were to have a loss in the midst of an embargo or a lockdown or a pandemic of this nature, naturally the period of indemnity, the period of interruption would get prolonged, and it would be partly contributed to by things like customs clearance getting delayed, prohibitions, trade sanctions, embargoes, a slowdown in the economy. So all this would prolong the loss. And the intent of having this clause is to protect insurance companies from uninsured losses. So what they're trying to say is that they will pay for the interruption caused by the event, but not by the prolongation caused by uninsured events. And the way we need to get around this is to keep a tab during the period of interruption of every day of interruption and what it's caused by, whether it's caused by a physical loss, whether it's an uninsured event. So keeping a tab of each day of interruption will save a lot of trouble later on. And insurance companies won't have to make assumptions when they're computing the loss. They get the data from you and they can calculate the loss accordingly. And this will definitely go a long way in bringing out a satisfactory result to a BI loss estimation. Next slide, please. Yeah. So now just to demonstrate to you how losses are interconnected. So gone are the days when we could view losses in isolation. So whether it's a climate change, whether it's an infectious disease pandemic, it's going to have a cascading effect, a domino effect, and you're going to have a whole range of risks coming into play. For example, a climate change risk could result in social instability, could result in involuntary migration, which in turn could result in unemployment and result in a financial crisis. Similarly, a pandemic caused by an infectious disease could result in unemployment, social instability, financial crisis. It could also result in cyber attacks like what we are seeing right now. So the risks are very much interconnected, and the idea is to control them at an early stage, because if that's not done, it could definitely have a cascading impact. The risks could spread, and as a result, the entire economy and various industries get impacted, and you have a global downturn like what we are going through right now. So to minimize the chances of this happening again, risks like these have to be controlled and arrested at an early stage. Now, this can't be done at an individual level by us as individuals, but as a community, if we act consciously and responsibly, definitely this can be controlled at an early stage, and we can prevent disasters and instances like this happening in the future. Next slide, please. Now I'll take you through a poll question. That's the fourth one in sequence. And if you could buy insurance protection for pandemics like what we're going through right now, how interested would you be? Very interested, interested, not interested, or not sure? Yeah, can we have the result? So as expected, 42% of the participants have voted that they will be interested, and we can see there's a growing interest in the area of pandemic insurance. And my colleague Seth Peller will talk about the nuances of insurance and also some parametric protection against pandemics. Over to you, Seth.
Right, thank you, Pranav, and good afternoon, good evening, everybody. I'm just going to go back to the first poll question, actually, which was how are you feeling today? And Jimmy said, feeling great. So that should have been one of the choices we put on there. So I agree with you, Jimmy. I'm feeling great, and we should put that on the choices going forward. My name is Seth Peller. I'm calling from Hong Kong. And I've probably been working on epidemic risk insurance only for about 18 months now. But so actually before COVID-19 hit, and it's been a kind of fascinating 18 months, I have to tell you. But if we look at epidemics themselves, outbreaks are becoming more frequent and more severe. So as a result of environmental shifts, climate change, deforestation, urbanization, and global mobility, the reality is we are seeing on average 200 epidemics a year. But I think this one, COVID-19, took everybody by surprise, and the sheer scale of it was totally unexpected. So it's blown all modeling out of the window. And I think we just have a fact here that between 2011 and 2018, the World Health Organization tracked almost 1,500 epidemic events in 172 countries. So it's nothing new, but it is new for us, something of this scale in this century. Now, this is actually a public health emergency of international concern, and we've actually had about 8 of those over the last 10 years. So it's almost 1 every 2 years if you do the maths. So I think the sad reality is we're going to have to expect more of this going forward, but hopefully next time we can be more prepared. Next slide, please. So this is just a very quick look at major losses historically caused by epidemic outbreaks. SARS, which Dennis mentioned, MERS, Ebola, obviously. Swine flu was probably the worst in terms of economic loss until we get to COVID, which is going to be in the trillions probably. But swine flu there is a new strain that's now coming out in China. So even though COVID is still going strong, it looks like there's very high potential for other epidemics to come out at the same time or shortly afterwards. Next slide, please. So until April, when underwriters started to put on endorsements and exclusions for contagious disease, in terms of non-damage business interruption coverage in your property damage business interruption policy, normally there was some element of it. It would be sublimited, and as Glenn and Dennis have been saying, you'd have to have the disease manifest on site and probably a government shutdown of the premises as well. So, but with that changing and the market now looking to exclude all risks and all claims coming from contagious disease, there is a solution, which is a standalone solution for non-damage BI interruption for epidemic risk for any clients that are interested in certain industries right now. Now, it's been incredibly popular, and so it's being done on a first come, first served basis, mainly due to the limited capacity that's available. And the underwriting information is quite simple. It's a completed questionnaire. Now, that would include explaining how your business has been impacted by COVID-19. I mean, some businesses are considered essential services, so they haven't really shut down despite certain government lockdowns, but others have. So those that have been affected that are in the current underwriting appetite, there is an option to pursue it. And limits, well, when we started this 18 months ago, limits available were $75 million for business interruption from a contagious disease. Now that's come down because of so much interest, probably to $10 to $25 million at the very high end. Now, coverage is basically on an indemnity basis. We say here it's hybrid parametric option, but that's actually kind of going away right now. And underwriters are focusing on the indemnity basis, similar to, as Glenn was explaining at the beginning, to make sure that you are no worse off than you were before the event actually happened. And there's three different ways that we can structure the epidemic risk solution policy, which I'll come on to in a second. Now, as we've all experienced, the financial loss due to the lingering effect of an epidemic event is covered under this policy, because you would have a 6-month indemnity period, whereas when you could get cover before in the traditional PDBI policy, it would always have a loss of attraction adjustment to any BI claim. Now, the industries that this product is focused on are primarily hospitality clients, manufacturing, retail, and mining. And over the last 2 months, we've developed a real estate solution, and we're also building a construction industry solution. So as Dennis was saying, this is similar to what happened in 9/11, when terrorism used to be included in the property policy, then it was excluded, and now we have standalone terror market. So I think we can expect, and we already can see underwriters coming out with solutions for standalone cover going forward. Next slide, please. So the policy triggers, I'm not going to read all of this out, but essentially you would need a public health emergency of international concern, which is what the World Health Organization declare. And then you'd need a local transmission in country of that disease. And the insured event would be an epidemic outbreak that causes a shortage in revenue at the insured properties. Then the aggregate limit, as I've discussed, is probably $10 to $25 million available on the high end. And depending on your business, if you have operations in overseas, outside India, there is options and possibilities to build clusters for those international operations. So each cluster may have a sublimit as part of your overall limit. The deductible is 7 days, and the policy period is 12 months. Now, you could buy the policy now, and on day 363 have an epidemic, and then you would still have 6 months from the last day, almost the last day of the policy period. You still have cover at the end of that 12 months. So it's quite good in that respect. Indemnity, as I mentioned, it's a loss of gross profit subject to the limits specified, and it's a 6-month indemnity period. Now, it doesn't cover COVID-19 because it's an ongoing event. If you'd have asked me this, if you'd asked me for terms back in January this year, I was quoting cover including COVID-19, but that was subsequently stopped shortly, probably early on in February, and underwriters are no longer prepared to give that, obviously, because the situation deteriorated drastically. Now, other diseases that are excluded are HIV, occupational diseases, influenza, and endemic diseases such as chickenpox, which is always annually affects part of society, as well as vector-borne diseases, which are such as Zika, anything carried by a parasite such as a mosquito. So those are excluded, but they can be carved back if that is the concern that wants to be insured. Now, in addition, underwriters give some crisis management expenses. So in the event of an outbreak, as soon as it's been declared by the World Health Organization and you have a local transmission, you would get up to $25,000 reimbursed for immediate expenses such as face masks, temperature monitoring equipment, etc., whatever is needed to deal with the immediate steps of the next epidemic. Next slide, please. So this looks quite complicated, but really is kind of 6 simple steps. And once you have the first case and you've got a local transmission confirmed and the WHO declare a public health emergency of international concern, that really is when coverage starts to trigger. And there's 3 different ways that we can structure coverage. So the first option is on a severity basis. And this is the way we were quoting it probably middle of last year to various clients. And it's a bit of a morbid approach, but it's based on the number of deaths in country once a local transmission has taken place. So let's say the trigger of the policy was 100 deaths, then as you actually get more deaths from the epidemic disease, more capacity would unlock from which is being provided by underwriters once you've had the other factors confirmed. So that's probably not the most popular product at the moment. We'll go to the next slide, please. Sorry, this just illustrates how it would work. So, well, in this case, 25 to 250 deaths, but you would see that once you get to 250, you've unlocked the full capacity that you bought at the time, if you bought it on this trigger. Next slide, please. And then the other two options really are, well, it's very broad. So once there's been a FIC, a public health emergency of international concern, and a local transmission, that means coverage has been triggered. And that means once you have a disease that, or an epidemic that's going for, let's say, a period of 6 months, and it had to be a continual period of 6 months, then the policy would pay based on the limit you had. Now, you'd have to prove your loss because it's an indemnity basis, but like with any BI loss, you'd have to prove that. So there'd be nothing different in that respect. Now, some clients believe that might be too broad and they're only really concerned about having a FIC and the government actually then locking down the country. That's probably also a more competitively priced option. And that's where the WHO announced the disease is declared a FIC and the local government locks you down with a local transmission. So then cover would kick in. So those are the three options essentially for this product. I've just lost my screen. Hang on one second. Right, sorry about that. Yeah, so those are, I think they've been referred to as parametric solutions for epidemic, but actually they're more indemnity solutions. Now, if we look at parametric solutions, these are not really so much for epidemic, but they're more for weather-related events. So what we've seen as the actual natural catastrophic risk has increased over time, the frequency and the severity, these bring new challenges, and traditional insurance doesn't always sufficiently cover both, and it may mean waiting 12 months, 8 to 12 months or longer in order to get a payout for your indemnification policy. So I suppose the question is, what are parametrics? So really they're index-based solutions that cover the probability of a predefined event happening rather than indemnifying the actual loss incurred. And this solution will have a predetermined payout mechanism when predefined event parameters are met or exceeded. So if we go to the next slide, please, there's a graph which will illustrate that point. And this is really just looking at wind speed. Now in the market, these products, these weather-related products are known as cat in a box or storm in a circle. So this is how underwriters would kind of predetermine it. And depending, if we're talking about a typhoon, for example, or a cyclone, depending on the wind speed of that typhoon or cyclone, as long as it hits that circle and it goes at a certain speed, the policy automatically pays out. So there's no need to, well, there's minimum or no requirement for proof of loss. And it's become quite a popular product to complement existing traditional or conventional insurances. I know you're going to have a separate session on parametric, so I won't go into too much detail on this, but this is in a nutshell how it would work. Next slide, please. Yeah, and then there's some other examples here of parametric triggers, so earthquakes, hailstorms, crop shortfall, wildfire. So really, pretty much anything can be built a solution as long as you can find the index that you can use to predefine the parameters of this event. Next slide, please. And finally, the other aspect we see clients looking at now, I mean, what's happening with the hard market is that, you know, you may not have had any claims yourself over the past few years, but the cost of capacity has gone up, whether you had claims or not. If you had claims, it would go up even more. But some clients are saying, well, that's not fair. Why should we be penalized for increased market prices when we haven't had any claims? So they're coming to us and asking us for sort of more longer term approaches through alternative risk transfer mechanisms. And these are normally tailor-made, and they're contract structures or solutions really. And the ones that are of most interest lately are where you have a multi-year deal, probably for a smaller amount of capacity, again, complementing an existing program, not necessarily replacing them, although in some cases replacing. It really depends on your circumstances, on your risk, and on your losses. But if the clients that are interested in these products, if they buy these and they have no losses over, let's say, 3 to 4 years, they would get, or they could get, up to 60% of their premium back, rather than continually paying an increase over time. So there's very different ways we can structure it. Some also incorporate looking at a captive or a captive stop loss. And as I say, loss sensitive premium structures, swing plans is another way to look at it, where you pay a predefined premium, but if you have a loss in the middle, you would pay an additional premium, but if you didn't have a loss, then you would get a return premium back at the end of the 3 years. Next slide, please. And I suppose the main benefit of the alternative risk transfer solutions is that you get pricing certainty over the longer term, both the underwriters and yourself. So I think we've seen that as the most attractive benefit from these programs that we put together so far. And with that, I will hand back over to Pranav.
Well, thanks, Seth. That was an informative session on parametric covers and pandemic insurance. Certainly an area of growing interest amongst several insureds. So now just to sum up the sessions we've had from Glenn, Seth, and Dennis, it's not just important to have business interruption insurance, whilst it is important, but it's also important to understand the workings of BI. This is to maximize the benefit of business interruption cover when you really need it. So, you know, we need to understand the benefits and also understand the exclusions so that we aren't really under any illusions as to what's covered and what's excluded when a claim really happens. So we need to be better prepared for a loss event. So whilst BI is a tricky subject, it's an area for specialists. Clearly, our job is to demystify it, to simplify it, so that you're better prepared in the event of a loss and you aren't in for any surprises. So on this note, I'd like to leave the floor open for Q&A. So please feel free to either type your questions, or you can click on the icon on your screen which says raise your hand, and you can speak up because we'll unmute you so that you can say aloud your questions.
We actually have a question, Pranav, from Jimmy, asking if we could go back to slide 31. I don't know if it's possible to do that, or...
Yeah, sure. Dalati, can you go to slide 31? And also if you can unmute Jimmy so that he can share his views on that.
It's a lot of slides.
Well, hello. Well, it was a really very interesting session that you had taken.
Thank you, Jimmy.
On the parametric, that has really been, you know, really hit a nail somewhere, because Airtel has been struggling with these, frequent, increasingly frequent, and AOG perils which have been happening chiefly along the east coast of India. And every year, as a clockwork, we can actually predict, the second week of October, we have a major cyclone which happens. And every time, I mean, the nature of telecom business, the kind of small risk, but a quite spread out risk. And we incur losses. And like you rightly mentioned, it takes around 12 to 18 months for a settlement to happen. So this definitely,
Yes.
and in fact, I mean, before Parametric, and also you might be aware of the hardening markets in India, and we were really looking at the alternative risk transfer that was shown. And one of the key points, the first point which you mentioned of getting a greater certainty around the pricing as well as the capacity, that is
Yes.
exactly the bottom line that we were looking at. And uh, every year, near about, so while we get our annual budgeting for the next year insurance pretty much approved by the board and everything by
Yes.
say middle of quarter three, by uh, November, and then a new guideline comes out from GIC or somewhere, and the entire budgeting goes for a toss. And they're exactly lay a problem, and that's what really you know set that thought of looking at captives as a solution. And also, of course, the extended uh, delay in settlements. So all in all,
Yes.
so but these two solutions are really something which I would be very keen on, the parametric as well as the captive solution. So while yes, I'm interacting with the Marsh team for the captive bit,
Yes.
but the parametric is definitely of interest. So
Okay.
I would really
Great.
appreciate if you could send across a few more write-ups on these to my
Yes,
email
of
ID.
course. Yes. Okay. I'll get your email separately after this from Pranav and Ashish, and then we'll have a separate dialogue. But be happy to help you.
Sure. Thank you so much. Thanks.
Okay. Pleasure.
Jimmy, we are also having a dedicated session on parametric, coverages. So we'll invite you for that as well. So please feel free to join that as well. Thank you.
Thank you. Thank you.
Thank you, Jimmy.
Yeah, I think there's a question from Divya N on alternate solutions of risk transfer from captive, whether they're available in the Indian market and what industry and what risk exposure would they best suit. And there's another question again from Divya, how are parametric solutions priced compared to insurance? So Divya, very difficult to compare on the pricing. I'll leave it to Seth to comment on that. And yes, these solutions are available in India. They will be reinsurance driven, so the capacity will come from international markets. And request Seth to answer the question on what risk exposure they would best suit.
Yeah, look, I think really the ART can be structured for pretty much anything from what I've seen. So maybe you can give me a bit more detail about that either now or offline. But I haven't seen any, other than looking at something for a particular risk like Epidemic with these ART carriers, the standalone Epidemic solution, that's fine, but I can't think of any risk exposure that wouldn't be considered really. So I think it's pretty wide open. On the pricing, typically Parametric works on a rate online basis in terms of rating. So again, the answer is it depends, right? So it depends on, I'll give you an example. In Hong Kong, now in Thailand, we've had quite a lot of social unrest and civil commotion. And as a result, there's been quite a lot of non-damage business interruption losses caused to, in particular, hospitality industry. So there is a product for social unrest for hospitality, where depending on the radius that you have, you can actually price it accordingly. So I would say typically if you work as a rule of thumb between 3 to 5% rate on line, that should give you a rough pricing line. So if you're looking at a $10 million limit, you might be looking at $300,000 to $500,000 in premium for something like that. But again, it depends. The lower the radius for that product, the lower the price. And it depends on the historical losses of what you're looking to protect on the parameters that you use. But as a rough guide, 3 to 5% online, I would say is good place to start.
Yeah, thanks, Seth. And now we have two questions from Santanam Srinivasan from Neyveli, and both are very interesting questions. So we'll unmute you, Santanam, and you can say them aloud so we can have a more interactive dialogue. And then, yeah, we can move on to the other questions as well. So, yeah, Santanam.
Yeah, good day.
Yeah, thanks for joining, and please speak up with your question.
Good evening. Thank you, the delegates. As you know, recently one thermal unit, I have a problem, and there was a fire incident, and I am claiming BI for that unit, say unit number A. Okay. Are you hear me? Are you hearing?
Yeah, we can hear you, sir. Please go ahead.
Okay. Due to safety reasons, I am closing down units B and C. Okay. It is going to happen for another 60 days. It will happen for me to recover. Can I claim BI for unit B and C? So you 60 minus 30 days.
Yes.
Okay.
Yeah, so I'll just rephrase your question. You got one unit affected in your thermal power stations, and you stopped two others for safety purposes, and you want to know whether you can claim for interruption for all three. Am I right, Santanam?
Yes, sir. Yes, sir. Exactly.
So I'll direct this question to Glenn, who's our FACS leader for Asia, and I think he'll be best positioned to answer the question. Yeah, Glenn, you're muted, so you'll need to unmute yourself.
Sorry, I had unmuted myself. Yeah, look, it kind of depends on the type of policy that you would have and exactly what the arrangement is. So if all three units are all insured under the same policy and there is a clear requirement for you to close all three as a result of an insured event, then you could possibly argue that all three should be covered. If insurers could argue that there was no reason why you couldn't still operate two of the units while the third was being repaired, then you might have a problem with coverage. If each unit is somehow insured on a different policy, then again, that would create problems. So it really depends on the exact circumstances, but it's certainly something that you could certainly look into.
Thank you. Thank you.
And you have one more question, right, Santanam? So please,
Yes, sir.
please raise that as well.
Sir, we have, I think, your exposure to mines and mining industry, the machineries are moving mostly. Specialized mining equipments, bucket wheel excavators, spreaders are moving for their operations. When we were planning for machinery breakdown for these assets in a mega policy, insurers say this is treated as moving equipment. So there is no specific coverage for moving equipment. You have to go for something like contractor premises equipment. MBD can be given only for stationary equipments like thermal stations.
Yeah.
Now, you see, mining industry is, our mines is very big, and we cannot skip off that. This year we could not lodge. So I need a different best solution from you. That is my objective.
Yeah, so Santanam, I'll take that question. And yes, you can have a bespoke cover for your mining equipment, and that includes breakdown as well. So I'm not sure why the insurer declined your request, but customized cover can be designed to take care of breakdown risks for your mining equipment, and we're happy to help you out. So we'll be in touch after the webinar, and yeah, I'm sure we can come up with a solution. And yeah, you had a question on index and investment. Is it available? Can you just throw some light on that? your question is not entirely clear to us. So if you can just elaborate on that a bit.
In one of the add-ons, it is in Mega, we have an add-on class as index and investment, where there is some variation due to some reasons. I remember the name, because what it will, the increase is not definite during the time of quoting or tendering. Okay, after you get into that, the variation will come in. So they are fearing, they are not able to judge how much will be the variation. And the insurance companies, 4 or 5 people summarily rejected that class add-on. We could not cover this add-on. Normally, additional premium you can take on some insured or some basis. That will give us a leverage. We were thought of it, but everybody was, when 4 or 5 people say we are not able to force, and we have to forego that add-ons in the mega policy.
I think, Santanam, this will require a more detailed discussion. So we'll connect offline, and yeah, we'll address all your concerns. And I'm very confident we can come up with some customized solutions to meet your requirements. So thank you so much, Santanam.
Thank you. Thank you all of you. Thank you.
Yeah. Anybody else would like to raise their hand and speak up with their questions?
Yeah, we have one from Setul Shah. The add-on of coverage for communicable disease and other 2 add-ons. I think they're maybe referring, Pranav, to the 3 endorsements you spoke about.
Yeah, so yes, they are offered. In fact, they're compulsorily a part of the insurance policy. So they have to be there from 1st April 2020 onwards. So if it's not in your policy, you can be very well sure that it's not been printed, but it's very much there. So there's no real choice that we have in this respect. So the communicable diseases endorsement is there in every property policy in the Indian market from 1st April onwards. Yeah, Niladri, has anybody else raised their hand? I saw some messages coming. Yeah, so Santanam again, can we unmute Santanam? He'd like to, ask a few more questions. Yeah, Santanam, welcome back. So please.
Okay, because we have a, due to during one incident, and we are not able to reinstate one particular component. Okay, one lift work we are not able to carry out.
Yeah.
The incident happened 1 year back, and it will take 1 more year for me to reinstate. Okay.
Yeah.
Now the insurer is suggesting it will take 1 year, means time extension also is difficult, and the reinstatement value, this will be the amount you will get after 1 year.
Yeah.
And I am suggesting another alternative, go for this market value. As on date, I will suggest what is the price, and they are applying some depreciation and arriving at some value.
Yeah.
You take this value now, and or 1 year after that you take that value. So the margin is very big, because we could not compare. We have to justify the management. No, if the variation is 5 or 10%, we can do. Why this market value reinstatement, this variation, how to come out?
So I'll request Dennis to answer your question. And if I were to understand clearly, Santanam, you're asking about, why should you go in for a market value settlement where there's such a huge difference between your reinstatement value and your market value. Am I right, or would you like to correct my understanding?
Yes. But due to some reasons, we could not immediately. We cannot reinstate because of our procedures and availability. I think we could not.
Yeah. So you'll take 1 year to reinstate the damage, and you really would like a more meaningful settlement. So Dennis, can you please answer Santanam's question?
Yeah, that's a difficult position to in, because obviously, when we buy insurance for property, we effectively want to do it on the reinstatement, value, which is effectively is, the current replacement value of that asset as it stands today. So it's new for old. Okay, so you'll always have you'll be better off doing reinstatement value. There are some rare occasions, and this sounds like one of those rare occasions where, for whatever reason, you cannot reinstate. Some policies do give you some guidance around that. That depends whether, then you should do it to market value, which is effectively the old secondhand price, would basically take it as new and then depreciate it down to a level that effectively is the market value currently. But it's done very much on a depreciated value basis. There's other ones which is like the true market value, which essentially is what would this cost to buy this particular equipment secondhand. But you are right, there's going to be some very large variations there between the values. So it depends on how big the variations are, whether you should accept the value. So again, it sounds like the insurers to me were actually suggesting this rather than the other way around. And there's no reason why you can't negotiate this. It doesn't have to be one or the other. You should be able to come up with some sort of negotiation, especially if you are giving way to insurers in this regard. And if it's their suggestion, you could always use the leverage that would just wait until the reinstatement value, of the equipment is down the track. But unfortunately, there is going to be large variances between the two values. So I would suggest going through a compromised version. And one could be the market value, as in not the original value less depreciation, because that could be very low, but the secondhand value of that particular equipment today. That could be some compromise we may be able to achieve with insurers. But otherwise, you could be facing a very large variance in values.
Thank you, sir. Thank you.
Yeah. Thanks, Dennis. Anybody else would like to ask a question? Please feel free to type it out or click on the raise hand icon.
I think, Pranav, we don't have questions. So I'll just request team to showcase the upcoming events, and then we will sign off.
Sure.
Yeah. So these are some of the future events which we have planned. The one which is on 22nd October is on the DNO risk and related challenges, what we are seeing in the global marketplace. Then we have a deep dive on the cyber resilience. We have Tom from US, who is the cyber practice leader for us, and also Magda, who is the cyber risk consulting leader for Asia. So this would be a very interesting session to be in. We'll have parametric solutions being discussed, as Seth also mentioned earlier, and we'll be deep diving on the ARTs. Again, these sessions will not be very technical. The idea is not to have technical sessions, but to have more case study based, discussion over here. And the last one, we are looking at the risk finance optimization as to how analytics can, help clients in taking right decisions on what kind of limits, what kind of deductibles one should opt for. And again, we have a global expert on this area. So, all scheduled 22nd October, 2nd November, 3rd and 6th. So please join us for this event as well. And I would like to thank Glenn, Seth, and Dennis and Pranav for this wonderful session. Thank you, everyone. And thanks to all the audience.
Actually, we have we have one more question.
Okay.
I don't have an answer, but it's what is the uptake of parametric insurance in Indian buyers? So I don't know in India.
Yeah, so maybe Seth, I can just say a few words on that. So Elena, I'm happy to unmute you in case you'd like to speak, or we can just address your question, once you're muted. Either way. So if you want to be unmuted, please raise your hand. But just coming to your question, to be very honest, there's a very limited uptake of parametric insurance amongst Indian buyers. So whilst there are several inquiries, we worked on a number of inquiries, Elena, but very few of them have materialized, and partly that's because of a lack of awareness, but it is a very important product. And as Seth explained, the payout is much simpler as compared to traditional products. You have a faster settlement. You don't have to wait for months and possibly years in case of a large loss. The settlement follows a formula, and it's pretty quick, very speedy. So it's a good cover to have. Elena, would you like to say something more than what you've typed out, Elena?
Yeah, can you hear me, Pranav?
Yeah, we can hear you very well.
Yeah, thanks for taking my question. Yeah, we really we understand that parametric insurances are probably the solutions for the future. But in terms of how do you scientifically go ahead on, in fact, even delineating the trigger points, because I understand there's a whole host of trigger points that can be set and basis on, and since it follows the indexing method, so there will, that's how basically you structure a framework for the insurance, if whatever is my limited understanding of the product. So how do you go on, how do you advise probably a prospect or a client who on even setting the trigger points for the insurance solution?
Yeah, so
Well,
Seth, can you please
yeah.
answer the question?
Yes, so I think it depends really what your concern is in terms of what you're looking to get cover for from a parametric. But a lot of it will be determined by, historical losses where underwriters have seen certain losses hit certain areas, and therefore the probability of those losses happening is either higher or lower than, than the other. So that will dictate their pricing based on the probability of that event happening, based on the data they have. So that's really how they would do it, and they have a modeling data to support that. And depending on the location, depending on the risk that you're looking to cover, that's how it will be worked out at a very high level.
Thank you.
Sure.
Alina, if you don't mind, can you share, which company you represent so that we can connect with you later on?
Sure, I'll tag it.
I think we don't have further questions. So,
okay.
Yeah, great. So thanks everyone. Thanks all those who have joined this webinar, and thank you, Glenn. Thank you, Seth, Pranav,
Sure.
Dennis,
Thank you, everybody.
Thank you, everyone.
Thank
Have a
you.
good evening.
Thanks a lot.
Bye-bye. Thanks.
Yeah, bye.
Bye.